Alrighty, guys. So welcome back to the podcast here. Let's make sure we're live here on the podcast app here. So if you guys are listening to it on YouTube, all right, guys, welcome back to the podcast here. We're going to be talking about just some stock stuff today for day trading, because that is the most common question that I have here. So if you guys are watching on YouTube, all you got to do is drop a big subscribe. Let me know if you guys like these podcasts here on the YouTube channel. If you guys are listening to it on Apple Podcasts, Spotify, or any other platform here, make sure you guys subscribe or like the podcast, just so I know and I will know what you guys like. So, you guys might be asking, what are we going to be talking about today? We're going to just talk about a couple of things that are super, super important. We've talked about understanding day trading multiple times. We all know what long versus short selling is. We did talk about a little bit of stocks in play, how to find them. But we're going to be talking about why traders fail, how much capital to start with, and a little bit of balancing risk. So those three things here. So let's jump into it. So where are we here? I can't find it. Alrighty. So we all know the facts here. Day trading is tough. It's hard. Here, hold on. For those of you watching on YouTube, we gotta change it. We gotta keep it on green. Oh, there we go. Green because we make money. So, why do traders fail? Well, this is it's an easy topic, but it's definitely underappreciated. So just like being a doctor or a lawyer or a other professional, engineer, anything like that, it takes practice. These professionals go to school for 6, 10, 12 years, maybe not that long, but they have a ton of experience. Now, they make roughly the same amount of money. If you compare an average day trader salary to an average engineer salary, it's going to be very, very close. Now, these engineers or doctors or whoever you're comparing to, they go to school for such a long time, and during that time in school, they're studying every single day, day after day after day, treating it like a job, going at it hard. And that's the same thing with becoming a day trader. And one of the main reasons why day traders fail is because they don't realize, first of all, how long it can take, and they don't understand that it's a process. They think it's kind of like a get rich quick scheme, not a scheme, but just to get rich quick. Now, I'm not saying you guys can't get rich from it at all quick, because there's been times where I've read where people have made $6,000 plus their first trade, and that's pretty much getting rich quick. It's almost quick as you can. But these people, they just don't understand. They don't understand that it's a process. They're uneducated, and they just don't practice. Imagine if let's say you were a heart surgeon. Now, you read a couple of books, you watched a couple of YouTube videos. Now you want to go do heart surgery. Realistically, that's not going to happen, and you just have to understand that's how it should be. Another reason why day traders fail here is they don't understand risk. So pretty much balancing risk, whether it's a long-term investment, short-term trade, one of the biggest things you guys have to ask yourself is how much is the upside potential and how much is the downside potential. How much upside and downside risk should be expected. I kind of said it funky the first time, but pretty much what this is saying here. So upside risk. So how much profit are you pretty much willing to get for that downside risk? Now, the ideal situation would be asymmetrical risk reward. Very, very important term if you guys don't understand it. But pretty much what this means is you risk 6 cents to make a full dollar. So an investor or a trader could pretty much try 16 times before they lose money. Now, you might be saying, Carter, how, okay, like I get it, but how can you even find stuff like, how can you even find opportunities like that? Well, if that was kind of a broader example, but realistically it's going to be 3 to 1, or 1 to 3. So you risk $1 to make 3. So you can try 3 times and then you break even if you lose. Now, realistically, you're going to have those times where it's 50-50. So you're not always going to be in the green, but all right, that's just understanding risk is super important. I don't want to go all day into that topic because I can talk about that. The next thing here is repeat failures. So this is probably the second worst thing, other than gambling, a trader can do is to repeat failures. This would include doing things like buying into a downward trend on a swing trade, or unsure of a strategy, and you just try it out. No paper trading. You just try it out. You lose money, and then you try it again, thinking you're going to be profitable. So anytime a swing trader or trader loses money, they have failed the markets. It's our job pretty much to make money. It's our job, and if you don't treat it like that, it's gonna hit you in the face when you look at your account. I can almost guarantee it. All right, so moving on here, we're gonna be talking about how much capital. How much capital, I can't talk, to start with. Now, to start day trading every single day, you pretty much need a required amount of $25,000 to day trade. If you fall below that standard, which a lot of people do, you only can make 3 day trades within a 5-day day trading period. That is called the pattern day trader rule, or the PDT rule. There is some ways you guys can bypass these rules by using offshore brokers such as SureTrader or TradeZero, or you can just open up a cash account. Now, cash account is good, but it takes roughly 3 days for your cash to settle. But if you have $15,000, $20,000 in your account, and you're just trying to get over that hump of $10,000 to $5,000, now realistically you're not going to be using all of your account on a trade, because that's not good. So you can kind of trade with it almost full time there. So many brokers also offer leverage. So for those of you that don't know what leverage is, it's a investment tool or strategy. It's used by traders who they borrow money from the brokers to place trades. Leverage is very risky, but used correctly can double, if not triple, your trading account within a week or so. That's why you can see those small accounts. I'm sure you guys have seen them on YouTube. That's why you can see them double, triple within a week, is because those people are using leverage. So when you first open up your trading account, it's better just to start small. Start small. Build up your account. Even if you're using SureTrader, I've used SureTrader countless of times, building up small accounts. Turning, what was my last challenge? 500 into like $7,000. But so you gotta open up a small account, build it up, then you can start kind of learning it more. you will be able to see more perfect setups. Only trade the rest, leave the rest, especially with a small account. And if you don't, if you don't trade perfect setups with a small account, your account's going to suffer. But if it's very easy to do that. So what I would recommend doing, start with around $3,000 to $5,000, so you can easily make $300 to $500 a day. Build up that account to 25,000, 20,000. I know that seems like a lot, but if you're consistent day after day after day, making 400, lose 200, make 500, make 300, lose some money, because it's always going to be it's always going to be 2 steps forward, 1 step back. Sometimes it's going to be 2 steps forward, 3 steps back. Now, those are going to be the times when you have to go back and reevaluate your strategy. Alright, so moving on here. Alright, we're going to be talking about risk a little more here. So whenever you make a trade, you risk money. It's our job as traders to minimize risk and maximize profit. You never want to trade large, because I could almost guarantee you'll erase the final profits there. So if you trade with a risk of $1 and a profit of 1, so a 1 to 2 risk ratio, you're pretty much risking 1,000 to make 2,000. Because of that risk, one trade will outweigh all those profits. So most traders, including myself, will adjust the risk based on a few things, such as market conditions, weekly performance. When I begin trading, when I begin trading, all I wanted was the large winners. Okay, very important. I just have a few bullet points here that I wanted to hit. So when you're especially beginner trader, all you want to do is hit those frickin' $2,000 days, $3,000 days. But instead of hitting home runs, you guys want to hit base hits. You guys want to get base hits of $100, $150, $200 a day. I wish I would have known that, because there would have been times where I've been up $600 within 3 minutes of the market open, and I hold it, or I sell it, and then I hop, back into it with a lot more buying power, thinking it's gonna pop up farther, and I lose, $400 or $500. Now that sucks nuts, guys. You have no idea. So balancing risk is a key component. And if you're very, very good with risk management, if you can get it down to, 1 to 3 or 3 to 1, I always get them mixed up. If you can get it down to like 3 to 1, risking $1 to make $3, then you can pretty much be wrong 33% of the time and still be profitable. Now, that is crazy. So you always got to understand, risk management. That's one thing I wish I would have known, just because it's so much easier to make money once you understand. Okay, this stock has a previous history of failing, previous history popping up, and falling. But me, I just want that big day, so I buy into it, and then it fails, and not looking at past history, and a couple of other things, because that's pretty much how you determine a risk. Is you see the upside potential, and you look at the downside potential, and if the downside outweighs the upside, then you can't trade it. It's not worth it. So, yeah. And I would never average down, averaging down is I can see why people would do it, especially if you're swing trading and, you see something that looks strong and it's just failing a little bit and you can get it at a better price. But if you're day trading a stock that is up 250%, and you open the day at $1.50. You got in at $2. Popped at $2.20. Didn't sell. Holding all your shares. Fell back down to $1.80. Bought some more. Most likely that's too big of a spread. You're not going to make money in that. You just have to learn, really. You have to learn how to trade. There's a science to it. There's a lifestyle to it where, geez, I am so tired. I am like falling asleep here. It's so late. Oh man. But I'm like talking and I'm sleeping. But yeah, so you just got to understand, just some key components here. If you guys have questions, I'm going to start doing these live so you guys can hop in, ask me questions, and we'll be able to go back and look at charts and in previous scanners up. But yeah, so I enjoy doing this little podcast for you guys. If you guys enjoy it, drop a big subscriber doodles. But I am tired, guys. So that's it, though. Just a little bit of a brief episode here. We'll definitely do some more. We'll talk about what should we talk about in the next trading emotions. We can talk about support, resistance, anything you want. But I am tired. I am going to bed. So I will see you guys in tomorrow's episode. Catch me live here in about 3 minutes while I put the trade idea scanner up. And then we'll be good to go. All right, guys, take care. We will see you guys tomorrow for either another podcast, video, or the scanner. So peace out.